Good afternoon, everyone. Nice to see such a big gathering. At the outset, let me say I feel pride to share the same stage as serial entrepreneurs like Manish and Jitendra. So thanks for the opportunity. I think what I'm gonna discuss more before I come to what Manish said, the new product which we feel very confident. What's been really the situation on the ground now? Because I think a lot of people would be anxious to know what's really happening, what happened last year, what's the outlook for current year, how do we ensure that our portfolio is designed and customized to ensure we reach our stated goals for the next 3 to 5 years, and what's the opportunity beyond that. So these are the 4 topics, largely where much of my discussion would be centered around, which is the first one being the polarization, the much talked about topic in the last 2 quarters. How do we see the profit versus GDP at the corporate level, all India level? What's been the trend whenever India has doubled its GDP, and it has happened between 5 and 7 years, and we'll look at that and our next big product. Okay, starting with 2019 trends, there was a lot of rules that were set in by various bodies, and this was one such rule that came in from SEBI in mid of 2018. But the ramification of that the investors, the various participants in the industry, we could see still as late as 2019, and we even seeing today, which is where they started categorizing large, mid, and small cap. So what did they do? They said, in general parlance, the top 100 is large cap, 100 to 250 is mid cap, and this is by market cap if you take it by descending order, and 250 to 500 is small cap, 250 and beyond, 500 and beyond is all small cap. So last year, 2019, the Nifty gave a return of 12%, the mid cap index gave a return of -4, while the small cap was -9. This was just 2019. Now, if I combine with the damage in 2018 at the index level, it will be much higher, which we'll see in subsequent slides. That had an impact on the volumes that obviously squeezed GDP. We have all known, Jane showed in one of the slides, we're at 4.5% today, but we believe it's kind of bottoming out. Some of beyond Demon, I think the GST, RERA, and currently the NBFC crisis, the pain is still there at the system. And it's more at the SME and MSME sector, because that's more than 50% of the economy, which we don't really feel, which we don't really see, because 90% of those companies or more than that are not listed. So really you need to really, when we talk to people like you and me, I'm sure a lot of people here are businessmen, and they would kind of allude to that fact that there is a real pain at the ground level, which I'm sure we'll see a bounce back. But what are the triggers, and that we'll discuss. And obviously the last point, which is becoming bigger. So we've seen Asian Paints. I'm just taking an example. Asian Paints had a market share of 40% a decade back. It today controls more than 50%. It had, in fact, about close to 45% before all these crises came. So it's, the leaders are becoming even far bigger. I mean, just to give you a reference, since we're discussing this, last 2 quarters, the paints industry has hardly seen a 2-3% growth. But can you guess what Asian Paints has grown at? 12 to 13%. That's the kind of, impact some of the leaders are the benefit they are getting when they're trying to capture market share. And this is their opportunity, and therefore they want to seize it. Here, what we're trying to highlight is what's the Nifty's performance vis-a-vis the mid cap and the small cap index, and these are all NSE, and we have rebased it to 100 starting with 2012. So essentially, if I look at 2017, there was a big period, between almost 15 to 2017, where Nifty was not growing or delivering as much as some of the stocks in the small and mid cap. and therefore you see a big spike there, which has led to that big divergence. Come 2019, we are at a phase where Nifty is in a different trajectory. As you said, it has grown at 12% last year, while the small cap index is struggling to even reach the levels of 2015 or some part of 2016, while mid caps index is also is slightly down. Okay, since I come from the research background, the idea is not to scare you, but you'll see a lot of numbers, but I'll try to simplify as much as possible and make it reader friendly. So essentially what we are here trying to highlight is, if I look at the Nifty's, the All India market cap, which is 147 lakh crore at the total, which is 100%, over 74% of that is coming in from large caps. Mid caps is about 15%, so that makes it about close to 89. The balance 11 is where, as I said, the 250 to 500 small cap 1, which is 7%, and the small cap 2, which is 500 to 5,000, which is the balance 4%. So essentially, the larger point is 96% of India's market cap is residing in the top 500 companies. That's also kind of leading to that polarization. The larger point in every slide that you'll see in the first area is that it's a huge polarization. And on the left, if you see, the small cap index, the mid and small cap bucket used to be at 21%, and it fell to as low as 19% in 2013, which is abysmally low number. And in 2017, it went up as high as 35%. So in hindsight, obviously, these seem to be anomalies, and therefore there was supposed to be a course correction, which has happened. And now at 26%, and this is all as of 31st December 2019, we are at 26% today. We are at the 15-year average, which is about 25%. So we have now, so the larger point here is again polarization, reversion to mean, and why we continue to believe that you can't really time it. So one of the basic tenets of our portfolio building, which we will talk about later, is that we believe in a multi-cap approach. So at any stage, one needs to be in across market caps, be it large cap, mid cap, and small cap. You really can't, because the other related part is that since we're looking at a 4 to 5 year tenure, we're not looking at, let's say, 2020, can it be a mid cap year? Maybe it will, but we can't say it with that much confidence. And we don't really want to time it in that sense, since we're looking at a 3 to 5 year, over which period it should all average it out. Okay, this is what the FIs and DIs, which control over 95% of, more than 90% of the investments that are done in the equity market, how they have, how have they have kind of distributed their investments in the last 8 odd years. So the point I'm trying to highlight here is the top 50 companies used to contribute only 16% in calendar year 2013-14. That went up to 36% and is at an astonishingly high level of 77% in the last 2 calendar years. The next, and in all of the other buckets you see there is a big decline. So 51 to 100 companies, 15% has dropped to 7. And you come to the last bucket, which is 300 to 500 companies, which is almost 0. And that's where the big damage is happening, because everybody, from the larger funds, they're trying to move to liquid names, larger names, where they are okay with a low, their risk reward, they have kind of toned it down, and therefore they're okay with a less reward, as long as they're not taking undue high risk. The other point to highlight here is, obviously, there is an impact from my macroeconomic numbers. So GDP has slowed from an 8% in 17 to about 6.4% in average of 18-19. Currently, we are about closer to less than 5. The Nifty, the percentage return has dropped in the last 2 years at 16%. The larger picture here is in the mid and small cap. As I was saying earlier, if I combine the calendar year 18 and 19, the mid cap has fallen almost 20% and the small cap has fallen over 35%. And this is just the index. The stocks within that obviously in that index and outside the index would have seen damage of much more than 50%. Just trying to unravel if Nifty has been a outlier. The market's not performed, it's only the Nifty which has performed. Within Nifty also, it's just the top 10 which have done well. So you see the entire 11.5% return has come in from those top 10 stocks which have gone up. And those are the top 10 stocks on the right-hand side. The other 40 have actually been minus 2%. Another takeaway from that is, out of those 10, 7 are from the BFSI space. So it's only an Asian Paint, a Bharti, and a Reliance at the top, which are outside that BFSI space. So that also tells the kind of impact that an NBFC, a crisis like NBFC, and coupled with the fact that there is hardly any money in the market, the big are getting bigger, and therefore the FIs and DIs are trying to chase some of the larger names. They get liquidity, they get comfort, and therefore, so it's all leading to that polarization effect, which is a larger message we're trying to drive home here. Okay, just looking at some of the sectoral trends within that Nifty. So if Nifty is delivered, Nifty 50 is delivered 20%, it's only 3 sectors, which is reality, the private banks, and NBFC, which have outnumbered the Nifty returns. All other sectors are low single digit and in fact negative. In fact, the 2 surprises here are the auto sector and the pharma sector, which have gone down to as much as 10%. Another thing to highlight here is incrementally we all want to be looking at Nifty 500 because that's a larger, better benchmark to look at versus the Nifty. And if you look at that, that's delivered over a 7% return. So what essentially is Nifty 500? It's largely the top 500 benchmark that's been created, within which Nifty is also there, but within which Nifty contributes about half of that. The balance half, 50%, is those companies which is between 51 to 500. With obviously the lower the market cap, the lesser the weightage. Because since we are saying we look at more from a multi-cap approach, therefore this becomes a more relevant benchmark to look at besides Nifty as well. So what's the outlook? I think the year we have started with fair bit of volatility. We have had Brexit, we have had the US and China. Finally, the presidents have finally stopped tweeting, and they finally ended up using their pen and paper when they signed the deal. Then came the budget, and recently, every passing day we get to know about coronavirus, and everybody has their own views. So that's a start. What do we look forward to? I think the US elections, what's the outcome there? The monsoon, turbulence in auto and NBFC, does it stop in the current calendar year? I'm sure a great part of it would happen. And finally, when do we see the big jump in earnings, which is what we have all been waiting for? What are the tailwinds? I think it's been after a long time that we are seeing a good Kharif and Rabi crop. And Rabi is actually, this is the second consecutive year, and therefore that looks to be helping. Crude is definitely, the softening of crude is definitely good for India because we import so much of crude. And finally, as I said, the number of 4.5% seems to have bottomed out. So what's our view on the broader Nifty? Because since that is a benchmark that everybody has, our sense is that this year we're looking at an earnings growth of close to 10%, which is FY20 at 530 rupees. In FY21 and FY22, which is the next 2 financial years, our sense is a base case 15% can easily be looked at. Now the swing here could be 5%. A worst case, we could be a 10% up, if not 15, and a best case could also be 20%, because we'll see in subsequent slides that we almost close to the bottom. There's a lot of catch up to happen. On the right hand side, there's just a sensitivity done. If I look at 701 as my EPS for FY22 and 20 as my PE for the fair case, what's the implied number on Nifty, which is 14,000. So essentially what we're saying here is, just to highlight why we have taken that 20 PE. So the Nifty PE in the last 5 years has averaged about 21. Last 10 years it's averaged about 20, and the last 15 years it's averaged about 19. That's a long-term trend. 15 years is a good period to look at. So essentially, what's a larger message? That is, our fair price range is closer to 14,000. Near term, we're looking at between 12,000 to 13,000. As I said, looking at some of the events which are due, and how much of it really gets phased out, because you can't have all of it in the next 3 months. Obviously, it gets scattered, and that's how the progress is. We see a bounce back of quality mid and small caps. The large cap should continue for some more time. I'm saying that the amount of craziness that was there in large caps, I think select large caps would continue to drive it, especially in some of the larger sectors. However, if you're looking at a space like BFSI, consumer, and banks, I think there's a large window of opportunity for some of the tier 2 companies to really bounce back, because they face the maximum brunt. And lastly, I think as I said, our multi-cap and multi-sector portfolio will ensure we'll be able to give returns which is really healthy. Okay, this is where I move to the next topic, which is corporate profit versus GDP. So essentially, what are we trying to do here is we're looking at India at an aggregate level. And here, I mean, you can use India, you can consider India, the Nifty, the broader market as a stock, and therefore we are trying to analyze what really happened and why we are where we are today. So we have taken the data for the last 15 years, and we have tried to highlight a couple of things. One is, the market cap, as at the bottom left, 156 lakh crores. This is as of today. The previous slide was as of 31st December. This is as of today. Against that, the expected profit at an all India level, which is the 5,000 listed companies, is expected to be 4,31,000. Sorry, and mind you, this is the 15% growth is coming in. A bulk of it is coming in from the tax cut relief that was announced. Had it not been for that, we would have probably been, not have grown beyond 3 to 4%. So the larger message, as you would see from that slide, and it's evident, is the profit is the same as that of the year FY13. Our margins at a net profit margins, NPM net profit margins, which is the net profit by sales, has declined from a high of 10% to 3.7% in the last decade or so. Taking that discussion forward, if I combine that with the market cap to GDP, our market cap to GDP currently is at 76%. We've been as high as 95%, which was the year FY08. If you look at the average for the last 15 years, for this period, it's been about 75%. So we are just about in line with that. But the problem is with that 2.1%, which is the profit to GDP. Now, if I look at that in context with the high, which was 6.3%, if I look at it in context with the earlier, FY13, which we were looking at, the profits being the same, it was about 4%. And if I look at it in context with the average for the last 15 years, which is again 4.2%, we are at a multi-year low there. So the larger message is there is a huge room for expansion. And the moment that happens, and there will be a impact, there will be a positive rub-off on the market cap, and we would possibly go higher than even the 95% that we have seen in terms of market cap to GDP. So that's a big room of improvement. I mean, it might take a couple of years. It's not something that we are saying it's going to happen in 2 years, 3 years. It might take 5 years, because by the time we double our GDP next, which is in the next 5 to 6 years, I'm not saying it's going to be there, but even if it becomes 3%, there is a big improvement we are seeing there. So, one of the tenets that we have in our portfolio building is our belief that, India is going to be coming, or India will end up achieving that target of 5 trillion by 2025. So essentially, what happens? I mean, what if we double our GDP? Because we have done it in the past. So what were the learnings that we have seen that were there in the previous 3 times? So between 2001 and 2007, we had doubled our GDP. Between 7 and 12, we had doubled. Between 12 and 19, we had doubled. So we had taken between 6 years, 5 years, and 7 years to double in the recent 3 times that we have doubled. What has happened there? The first time, the growth at an average level for that period was 12%. The next time it was 16%. In 2000, between 12 and 19, the average was 12%. And now, if I'm looking at doubling in by 24-25, we're looking at the GDP to grow on a nominal basis, which is the real plus inflation, to grow closer to 11%, which is definitely doable because all we're looking at is a number which is far lower than what we have seen in the last 15 years. And the 15 years average is actually 12.5%. Why? I mean, we could have taken a slightly higher number also, but I think the current economic situation and the base effect would obviously mean that, things may not be as rosy. So we'll have to kind of pass through the current year and the next year before we get that confidence that we can actually surpass that 10.9. We can actually grow at 12. And that's assuming dollar at 71.5, which is the current number. If dollar continues to depreciate, then possibly there might be an additional year that would happen before we reach that number of 5 trillion. So this is the other thing that we wanted to highlight is in terms of sectoral trends. So let me just give you some of the takeaways that we drive. So again, 2001 to 7, the GDP had doubled. 7 and 12 the next time, and 12 and 19 is the recent time when we have doubled from 1.25 to 2.6, which is the March 19 number. The Nifty 500 as the benchmark, the profits had gone up 400% the first time. Next time it had gone up 93%, and the last time it doubled has only gone up 33%. And the same has been the trend in terms of sales. You look at, there is a deceleration in the growth rate from almost 200% to 160 and 87%. I think besides the base effect, there are 2 other things. As I said, there is an absence of inflation in the last couple of years, the last 5 years, which is also leading to this, because India has seen the best growth at 15.5% that we saw. That was the best time, but there was a good inflation. So inflation we might see negatively as well, but it also does is it gives a huge benefit to the system at large, to most, and it also gives us the spending power so that we go out and spend, and that translates into a good profitability as well. So that's been one of the key things that has been missing. The other thing that I wanted to highlight is, you look at the first period, realty and telecom were the darlings, and you pick up any realty stock. I remember Unitech at 1 rupee and in 2001, 2002, and it went up more than 100x, more than 500x, and subsequently we all know where it is today. Same is with telecom. But if you look at the all-weather sectors or stocks, it's been private banks, NBFC, consumption, which has been the feature, which have been kind of driving in the last 2 periods, which is period ending 12 and 19. They have been the only 2 consistent performers in the last 2 periods. And there is not one sector which has repeated across the 3 periods that we have looked here. So that's the nature of the industry, that there is so much happening on the ground. You have new sectors coming up, like even with today there is this banks within that private PSU. You have NBFC, and now you have the other financials which are coming up, which is insurance and AMCs and broking companies, which is now getting listed, and their growth is even higher than what we've seen in other categories. This is just that, taking that slide forward. I'll comment on the slide on the right hand side. That pertains to the profitability. The one on the left is pertaining to sales. The orange bar, essentially what we're trying to highlight is at the right top on the right-hand side, the PSU banks. Look at their share in all India profitability, the drop there. It's dropped from as high as 15% to as low as 1% in just a matter of those 7 or 8 years. And 100 being the pool, that's been the contribution of PSU banks, just 1% contribution to profitability in that pool of 100 in the last doubling. Same happened with the overall manufacturing and infrastructure, and surprisingly, automobile also contributed there. Obviously, we had a high base because it had doubled just before that, but nevertheless, 3% is not a representation of the automobile sector. Now, metals also had a little bit of decline, then it kind of stable there. Energy is another sector. In any seminar that I go these days, one of the topics that we end up discussing is what's the future when India goes electric. Because it's bound to happen. It may take 10 years, it might take 20 years. It'll start with maybe a two-wheeler. It'll go into the essential utilities, the buses, the buses, the autos, and then possibly four-wheelers, and lastly on the CV side. But it's bound to happen. So you clearly see energy has already lost the contribution from 24% to 15% in the last 15 years. So what's our sense? I think directionally this trend will continue, which is we will keep on seeing the reduction in contribution of these sectors. In PSU banks, there's hardly any room for reduction. You can't go into minus. But I think from a larger sectors, where it can go down further, one is metals and the other is energy. And these are two sectors we don't really tend to go heavy on. We don't really get excited because looking at this, charts like this, numbers like this, or you don't really get a confidence, when you take a 3 to 5 year view. Where do we go heavy? I think those green colors, our senses would be even dark green and maybe ultra dark green by the time we reach 2030. By the time we 2031 or maybe by the time we end up achieving $10 trillion. So I think our large two bets would be consumption, within that largely discretionary, and the second one is financials. Within that, again, the discretionary part, which is more on the spaces that I just discussed, which is the insurance and AMCs. So just to conclude, we are in a period where 2003. Jiten mentioned this in his earlier slide. There are a lot of similarities that we are seeing in terms of 2003. Having said that, the larger disclaimer is we're not saying the Sensex is going to double in the next 3, 4, 5 years. That happened. Obviously, it's going to take its own pace, time, depending on how earnings growth comes back, confidence comes back, because there are far too many things that need to happen together for us to really double in that sense. But the larger message is all signs point to the fact that we are close to the bottom in terms of the larger market. We are not saying again Nifty or a particular index from a larger market perspective. So there are enough growth opportunities that we see when we're looking at that 5 trillion number. Mid and small caps, I think, should see a bounce back, limiting the polarizing effect. Multi-sector, it helps us reduce the risk. And sector rotation, we just saw in the previous slide, that also gives us enough signals